Hello and welcome to this IBSA podcast on the topic of US exposed persons moving to Europe. My name is Roy Saunders, founder and chairman of the IBSA, the International Business Structuring Association, which is a multidisciplinary global association of entrepreneurs and their professional advisors dedicated to sharing their expertise with each other within a great networking platform. And today I'm joined by Darren Hayden-Joseph, specializing in international cross-border taxation for US individuals. Maybe they're moving to the UK or beneficial regimes such as Spain or Italy, or other fairly high tax jurisdictions such as France and Germany. Darren will also be covering the taxation of trusts in the US and beyond. So there you are. Darren, what are your key points that you'd like to talk about?
Hi, Roy. Pleasure to be here again. My name is Darren Joseph. HEJ.tax, a member of Moore's Rule, and we're a team that seeks to demystify the sometimes confusing rule of international tax.
Can you tell me a little bit about the exit tax that would apply? And would the exit tax apply to green card holders as well?
Right, that's a good question. And yeah, I always give my point of view, but to your point, we do 2 or 3 clients every month who are giving up their citizenship or green cards, right? So it is a personal choice. Yes, an exit tax may apply. If it is your citizen and your net worth is in excess of $2 million, or you've had a tax liability on average over a certain threshold, it moves with inflation, but I think it's roughly, let's say, $190,000 for the preceding 5 years. Or if it is that you're a long-term permanent resident, and what we mean by long-term, so you've held onto your green card for at least 8 years. So then you trigger. So if you've held onto it for fewer than 8 years, then exit taxes won't particularly be a concern. So again, for that long-term permanent resident, you trigger what we call covered expat status by virtue of your net assets being in excess of $2 million, your average tax liability being in excess of, let's say, $180,000 over the past few years. There's another way of triggering it, which is those who refuse to disclose what their assets are, but we don't typically deal with that type of client. So essentially, yes, you may trigger that exit tax. And how the exit tax works, just real top line, you create a balance sheet, if you will, of what your assets are, what the basis is, so the cost price, as well as the market value. And we look at the delta between the two, and that delta is looked at in terms of a deemed disposal. And we know you're not going to sell it, but you kind of pretend as if you are, and based on that, the tax is calculated.
But, unlike some countries which do have an exit tax, but they also have a step up in basis on when they come into the country, I believe that in the US, you don't have that step up in basis. So it seems a little bit unfair. Some people have come to the US with a low cost and be taxed on exit.
Absolutely. One can have that conversation. Of course, as professionals, we all advocate pre-immigration tax planning, regardless of where you're going to. But the vast majority of people do not. And as you rightly pointed out, there's no automatic step up in basis. So as part of the pre-immigration process, we do certain things to step up basis. But if you didn't take advice, then you're right. You can be in a painful position should you wish to exit.